Hi and welcome everybody. This is Josh, the Client Experience Manager here at the Exit Planning Institute. I wanted to thank all of you for joining us today. This is our May free webinar, part of the yearly free webinar series. Today we're very excited to have Laura Malone presenting. She's a Vice President with the American Endowment Foundation. I'll let her get into a little more of her background, but before we get started, a couple of housekeeping notes. Everyone is muted today, so if you do have a question, feel free to use the question box in the GoToWebinar control panel, and I will get to those as we work through the presentation, and then again at the end of the presentation, time permitting. Secondly, today's webinar is recorded, and the broadcast will be posted up in the Member Center for you to review. For those of you joining us from an invitation from Laura, there will be a link provided to you where you can access the recording of this webinar and share that around. And then finally, at the end of the webinar, you will be asked to fill out a short survey. We'd really appreciate your quick and honest feedback on today. So that's all from me at this time, and I will turn the program over to Laura.
Thank you so much. I really appreciate it. Just a little bit of quick background about American Endowment Foundation. We have been collaborating with the Exit Planning Institute for probably about 3 or 4 years now. Initially, it started as us working to help them to create charitable content for their SEPA designation, and I typically do travel for those SEPA designation sessions to teach about philanthropy. It's a very close passion of mine, as is how it can dovetail with business and with that exit planning for business owners. So I'm really pleased to be here today. Just quick background about American Endowment Foundation. We are a national donor advised fund solution, and this conversation is really going to be more about the overarching principles of philanthropy and why it's important, more so than about donor advised funds specifically. We will touch on those briefly only because they do tend to have some subtle nuances that not everybody is currently aware of. For instance, I met with a financial advisor today who had never heard of donor advised funds. So we will touch briefly on that just so you can get a better understanding about how those can be implemented compared to the more traditional senses of private foundations, charitable trusts, and so forth. We do a lot within this space. We handle numerous non-cash transactions a year with business owners looking to exit their business. We're also doing more in the space of helping companies create corporate philanthropy utilizing donor advised funds in place of private foundations. And typically in those scenarios, we are working collaboratively with the client or the company's financial advisors, allowing them to continue to custody and manage the assets. AEF does not manage or custody assets on our own. We are not an investment company. We typically do not compete with the trusted advisors like the financial service professionals, the CPAs, and the attorneys that are working within this space. We are very much a collaborative partner, which is why we've been partnering with the Exit Planning Institute for the last couple of years. A couple things that we wanted to cover is really helping advisors and trusted advisors like yourselves recognize, if you don't already, why discussing charitable planning with business owners is important, helping to identify how to spot opportunities to discuss charitable giving with the business owners, some of the advantages, disadvantages, and tax effects of those gifts, illustrating how to implement current charitable gifts of closely held stock in advance of a sales agreement, and then explaining some of the other gifting techniques that can be implemented before the end of this year, through the course of this year, as you're dealing with business owners, either using this as a corporate giving vehicle, but then also too, if you have business owners that are looking to potentially leave their business and start to phase away from the business, ways that this can be utilized to help dovetail to make that transition a little bit more easy, a little bit more seamless for that business owner. One thing that tends to be overlooked in a lot of cases is the prevalence of charitable giving in our communities. The data for 2015 is still being processed. There are reports that are due to come out within probably the next month to 60 days related to those statistics for Charitable 15 and giving, but 2014 contributions were over $350 billion. And yes, you're looking at that right, that is billion. Charitable giving typically makes up about 2% of the GDP. It's also usually something that is done by over 90% of individual families, in particular within the high net worth space. Entrepreneurs are no different than that. If you look at some of the statistics on this slide, typically about 90% of entrepreneurs donate money either personally or through their companies. Beyond that, they may also dedicate time. They may dedicate employee resources. They may give things in kind to further their philanthropic causes. But what really stands out to me is really that next point about the percentage of company profits in more of the smaller to middle market companies and how much they dedicate to charitable causes. That tends to be, looking at that, that's 3%. And while that looks like a small statistic in general, larger corporate counterparts and the general rule of thumb is typically about 1% of profits to be dedicated in order for the company to be considered corporate social responsible or focused on philanthropy as part of a corporate entity. Like I said, a lot of the larger multi-million-dollar companies are usually somewhere within that 1% to 1.5%. So the fact that with a lot of your clients that may be business owners, the fact that they're giving in some cases double to triple that amount, to me is huge. And it's a fallacy to think in a lot of cases that the business owners are not doing something. Another thing that tends to be perpetually overlooked is the idea of what stage the business owner feels they need to be in before they start to support these endeavors. 70% of the entrepreneurs surveyed within this survey that was done by Fidelity related to entrepreneurs and philanthropy said they did not want to wait for success to give back. We've seen this with some of our entities that are building a business, creating corporate donor advised funds with us. A lot of times they're doing this in the early stages of the business. More and more you're seeing companies being created with a social focus, with the desire to collaborate within philanthropy, do good things and good works with their assets in the company, making it part of their overall strategy that they're taking to market. So the fact that a lot of these business owners are doing this, I think, is only going to grow as time goes on, especially as the business owners get younger and younger as we go on. Furthermore, a key part of this is that most high net worth individuals, and in a lot of cases this includes business owners with their personal wealth, are interested in receiving help in understanding what assets to contribute. We're going to touch on a few things going forward about the various assets that can be given, either at the corporate level or at the personal level of the business owner. One of the biggest things that we see is predominantly 90% of philanthropy is done in cash, whereas 90% of the wealth is held in assets other than cash. And in a lot of cases, the business owners, the high net worth individuals, don't have experience in how to leverage those other assets beyond just giving away the cash. So cash ends up being the default, which allows that business owner to miss numerous other opportunities to leverage their philanthropy, to leverage their personal dollars or their tax-free dollars in ways that they aren't attaining by giving cash instead of those more complex assets. And then also, too, almost half of these individuals surveyed really wanted help in choosing what giving vehicles make the most sense. It's not uncommon now for us to see wealth holders, business owners, individuals that have more than one type of giving vehicle. They may have a private foundation and a donor advised fund. They may have a donor advised fund tied to a charitable trust. They may have a charitable remainder trust as well as a charitable lead trust paired with either the private foundation or the donor advised fund. The most prevalent answer is now all of the above rather than one of the above in a lot of the cases that we see. So it's important for advisors to understand that when helping their clients go through this process. Also, how do these folks give? Bank of America recently has a study that they do every 2 years. The new one is due to come out soon, related to high net worth philanthropy. Close to 90% of high net worth individuals give less than $100,000. Over 60% have their largest gifts of less than $10,000, but a vast majority of them are using assets or income to fund their charitable giving vehicles. And while a third of them may be using giving vehicles, the vast majority of them are beginning to migrate to donor-advised funds as one of their primary giving vehicles. Of those high net worth individuals that give, business owners by far donate at the highest level compared to their non-business owner counterparts. So it's important to understand that the business owners, whether they talk about it directly with you, are doing this, and being able to help facilitate how they do that and improve on how they do that can create enormous advantages for the trusted advisor. In a lot of cases, we find in working with these advisors, because most of our work is done not just with the individual donor, but also their trusted advisors, including their financial advisors, their CPAs, and their attorneys. In a lot of these cases, having these discussions can distinguish the advisor's practice from their peers or their competitors. Surveys have shown that well over 60 to 70% of advisors that do this practice regularly feel that it does add bottom line to their value as a practitioner. In most cases, they say that it helps to enhance their role as a trusted advisor because they're able to create more meaningful discussions through philanthropy with their clients, and in a lot of cases, using that philanthropy to help build a bridge to the client's next generation. So think about this, whether it's within the corporate strategy or within the personal strategy. A lot of times, many of us are working within family businesses. So the ability to go ahead and use this, maybe those next gen that are in the business are not in executive roles yet. You may not be interfacing with them on a regular basis. You may not be interfacing with them on a regular basis if you're managing the business owner's personal wealth. But using this as a strategy to begin to build that rapport, build that relationship, has done wonders with a lot of the advisors that we collaborate with, and being able to mitigate some of the loss of control of that wealth when that primary founder or shareholder passes away. Also, a lot of times within AEF's program, not necessarily true within other programs, the wealth manager is always able to manage in custody those clients' philanthropic assets that are in their donor advised fund. And in a lot of cases, like these instances with business owners converting their non-cash wealth to liquid wealth, it does allow these advisors additional planning opportunities to create a plan for their clients as they're converting these non-cash assets into more liquid assets that can be managed or can be structured through other vehicles by these trusted professionals and advisors. So the way the donor advised fund typically works is that the donor is making a contribution to the donor advised fund sponsor, in this case, American Endowment Foundation. Because that donor advised fund sponsor is a charity, whether it be AEF, whether it be the local community foundation, whether it be Fidelity or Schwab, typically that sponsor, that donor advised fund program, is in and of itself a 501c3 charitable organization. The donor is getting an immediate tax benefit, an immediate tax deduction for the assets given to the donor advised fund sponsor. Those assets are put in the client's individual donor advised fund. That individual donor advised fund, in a lot of cases, acts like a family philanthropic vehicle, almost like a private foundation for the client's use. In AEF's case and in some other cases of other programs, those assets can be held with the client's trusted financial advisor. They can be managed and custodied on that investment platform. Those assets are held in the donor advised fund until the client decides to make grants to their charities of choice. That can allow them to separate the tax decision from the giving decision, which in a lot of cases can have that client begin to think more strategically beyond giving cash, looking at giving other assets that may be highly appreciated, may have subsequent capital gains, and may be able to go ahead and move forward with the idea of other assets that they can contribute. In particular, most common second to cash, we typically see marketable securities. Within the business owners, we are often seeing those illiquid assets, closely held stock in C Corps, S Corps, LLCs, limited partnerships. There may be residential or commercial real estate that may be in the business or been held separately by that business owner as other assets that they have in their personal wealth. We've seen oftentimes the contribution of maybe mineral rights. Also, in other cases, we've seen gifts of personal property, collectibles. Sometimes we've seen insurance policies leveraged, especially with the business owners. Sometimes if they have these policies as they exit the company that may no longer be necessary, may no longer be needed, rather than going ahead and surrendering that policy, having to pay tax on that policy, they may choose to donate that policy, get the charitable deduction. In some cases, we've even seen them surrender that policy to be able to get upfront liquidity today to facilitate their family philanthropy. If they're in a corporate position where they may have 401k plans or IRA plans, we may see them use the gifting of those policies in their legacy plans, in their estate plans, where they may go ahead and gift all or a portion of those plans to the donor advised fund at the time of their death, or they may allow the heirs the opportunity to disclaim those assets rather than pay the income tax that is related to them as the inheritors and beneficiaries of those plans. So there's a lot of different ways that the philanthropy can be leveraged to benefit the client and their goals. But in particular, where I want to start off with is the idea of looking at this philanthropy as a value enhancement for the company. In particular, and most importantly, the way that this philanthropy can be used to reinforce the company culture. And that can be pivotal for a lot of companies. I listened to a great presentation not too long ago about the idea of mergers and acquisitions and the role that company culture can play in the success of those mergers and acquisitions, or in some cases, some of the biggest failures that have been around in the M&A space have ultimately been because there wasn't a shared culture within those organizations. So being able to reflect an internal corporate culture can be extremely important to companies. And in a survey done of entrepreneurs, they personally felt in wide numbers that giving back as an individual was important, that they wanted to incorporate that philosophy into their corporate culture, that in a lot of cases they felt it was part and parcel of being a good corporate citizen and being responsible. In a lot of cases they had seen their own personal results where they felt that the giving enhanced their reputation or company brand, or in some cases both. In a lot of cases they felt that it may help them attract employee talent or bolster employee skills that some may not have seen if they weren't doing those philanthropic opportunities. It gave avenues for employees to maybe work in a space where it didn't fit their skill sets currently, but it helped them create those skill sets further down the line. And we'll talk more about that in a little bit. Overall, too, in a lot of cases, it improved employee respect and pride for the company. And in a lot of cases, it proved to be a differentiation point between them and their competitors. Especially if you think of now in today's space. You know, if you think of companies like Tom's Shoes or Patagonia or some of those other companies that are weaving in a philanthropic benefit, a social benefit in using their products and goods and services, the brand following that they have can be astronomical. And this isn't just the feedback of entrepreneurs. There's more and more studies being done in this case. A collaborative partnership between Campbell's, Verizon, and a company called the IO Sustainable has done vast amounts of research in how this philanthropic ROI can create a substantial change in bottom line for the companies. And they felt that in a lot of these cases, the idea of corporate responsibility assets, when they're properly designed, when there's sufficient investment made, could support returns related to multiple items. These are just a couple of them. The idea that there may be increased market value of up to 4 to 6%. The idea that there may be increased sales revenue in some of the data that they found of up to 20%. The idea of increased customer commitment among the core segment of up to 20%, but of the total segment as much as 60%. Also, too, the way that they could go ahead and from an HR standpoint, reduce the company's staff turnover rate by up to 50%. And this is just a small sampling of what is actually a 50-page report of different ways that they've been able to substantiate a true philanthropic ROI in taking on some of these strategies. Going back to what we were talking about with the employees and the turnover rate, the idea of employee retention and the lack of turnover, but also the way that it can increase and bolster employee skills can be hugely important in the valuation of a company. Being able to promote from within, because some of these strategies through the employee volunteer programs may help prepare these employees for management positions that they wouldn't have access to, or cultivate those skills to make them ready for these opportunities at a faster pace. Being able to put them in positions where they network with community leaders and the way that can help the company overall, the way it improves the overall perception of the company and the marketing potential. The corporate culture and the relationships with customers that are looking for these corporate citizenship activities, but also the morale, motivation, and productivity of the fulfillment that is one of the main reasons that may keep a lot of these employees from leaving. Can have huge value to employees and to the business owners as they're looking at their companies and trying to weave this into their corporate fabric and really have a substantiated and proven return on investment in these cases. A great example that we've seen is a company that we've worked with for a couple of years now. They operate primarily within the higher ed sector. They initially used about $500,000 of owners' assets to create a donor-advised fund as the corporate foundation. Their primary corporate principles are focused around helping to foster talent, creativity, and leadership and new ideas. So within those corporate principles, they've used this foundation to create scholarships, to help low-income single mothers learn marketable skills, to provide business training and vocational loans and missionary assistance that provide additional training outside of the U.S. and South America. But fundamentally, what all this giving has done is it's aligned with their role in the higher ed sector and really shown the folks that they collaborate with and shown the market that they're really walking their talk, that not only are they there in the higher ed sector doing what they do from their business aspect, but they're supporting those initiatives from a personal and corporate aspect as well. So they're really putting meaning behind what they do and allowing for those situations to go ahead and help them bolster their business. So where can you play a role as an advisor? What are some 5 simple questions that you could start to ask your business owners to really see if this is something that they would have an interest in? How are they articulating their goals and their business interests? What are some of their company values? What are their current giving that they're doing, and why are they doing that type of giving? How can they position these things to make sure that the giving they're already doing is aligning with a business need or an opportunity, or how are they aligning it with their business mission and goals? How do they want the public and the customers to perceive them, and how they do their giving as it relates to how they're positioning their company within their competitive space? But the interesting thing that happens with this is not just the role that this can make within corporate giving and helping the business for business's sake, but oftentimes the way that this can help dovetail with the business owner to help give them ideas for their post-business transition plan. Because a lot of times, as many of you have seen in the role of an advisor, that when the business owner isn't mentally prepared to transition out of their business, 9 times out of 10, it's not going to happen. Or if it does happen, the business owner is going to be hugely disappointed by the results of the process, or they're going to feel unhappy about the results of their exit planning. The Exit Planning Institute has their own State of Owner Readiness Survey that they have done and they're continuing to do over time. In the most recent incarnation, nearly 50% of those surveyed had no plans for their life after business plan. Less than 5% had a written plan, and maybe a handful beyond that had a plan in mind. But if they don't have anything to run to, then how are they going to ever leave their business? And we see that with the fact that almost half of the businesses may collapse due to the founder's death or due to illiquidity because the owners aren't making that plan for their exit. They're so focused on the business, they've never let go of enough of the business to really take the time to create that peace of mind, to really feel like they have something to go to. They've stuck in that one-sided role, or maybe they haven't found a qualified successor. And like we said, by engaging the employees, the employee engagement may prove to that business owner that they may have qualified successors at hand. They've just never given them that opportunity. 75% in a PricewaterhouseCoopers study reflected that they were unhappy after the sale of the business because of poor exit planning. Some of that might have had to do with, in their mind, the undervalue of the company, leaving hard-earned wealth on the table. Some of it may have been that they felt they paid too much in capital gains tax and estate taxes. Some may feel that they failed to realize that personal, financial, or business goals during the exit process. So the role that philanthropy can play in helping through that corporate philanthropy to create a picture for that business owner about what their life could look outside of the corporate philanthropic role, to maybe help them dovetail ways that they can still function as a leader, as a mentor, or in other ways guide their principles and strategies through how they're serving their community versus how they're serving their business, can have a huge impact. Also, dovetailing back to the PricewaterhouseCoopers study with the idea of too much taxes left on the table, the idea of leveraging the gift of giving their closely held stock or giving some of the assets in the company, the real estate that they may control, or other assets in advance of the sale rather than after-tax dollars, can do a lot to help offset their tax exposure on these matters, fundamentally reducing the capital gains that they're frustrated with, reducing the estate tax that they're frustrated with, in some cases creating a larger income tax deduction. If it's money from the corporation, not only if it's a C Corp, the corporate tax benefits may be limited to the C Corp, but if the company's structured in a shared environment of an S Corp or an LLC where there's pass-through down to the owner, there's additional tax savings that can happen to them from the ownership standpoint when they're doing their corporate giving, but also to, as we mentioned, the capital gains in the estate, creating an avenue for tax-free growth for these charitable assets, as well as potentially, if applicable, dealing with AMT if they fall into those categories. So the trends in charitable giving that we see, and this is a survey done by Social Venture Partners that has about 35 different partnership organizations across the country where they're dovetailing their time, talent, and treasure to give to charities. And in a lot of cases, these members of SVP take on a lot of a business owner consultative mindset. Many of the partners in SVP tend to be business owners themselves, either actively engaged in their business or those that have already made a transition out of their business. And what we're seeing through this survey is, in a lot of cases, the giving practices of business owners and other donors alike are becoming more strategic. It's no longer just giving money for money's sake. It's an idea of being more proactive and mission-driven. It's the idea of using a formal process or research-based data to make their analysis, making this charitable giving decision very much like a business decision they would do when they're running their other companies. Maybe collaborating with others, finding best-in-class partners, looking at the nonprofits from an infrastructure standpoint, putting on their consultative hat with some of these organizations where they can go ahead and really help these organizations from an infrastructure side where they can have a stronger, more sustainable organization to continue to do the work that they need to do. In some cases, it may be more of a focus on systems or policy impact. But in a lot of cases, it's a larger, long-term approach where they're taking more time to understand the power dynamics at play and really aligning and bridging what they've done as a business owner all of their lives into how they're creating their business practices. And especially when they transition and they're no longer running the business, they've maybe already exited, a lot of the other benefits that can come from that, not just using these business practices from the corporate giving standpoint, but also in their personal giving standpoint, is the residual benefits that can happen when they incorporate the family and the benefits for the family. In a lot of cases we see with the business owners as they're exiting their business, they may have greater concerns about the impact of the wealth and the family. They've spent all the time through the trusts and through the other legal documents to prepare the wealth for the family, but they come to the realization that they haven't done anything to prepare the family for the wealth. So how can they use the philanthropy to transfer the values and the purpose to create more than just a transfer of assets to the family? In using some of these same strategic giving practices, like you would in the corporate philanthropy, it can allow an intergenerational common ground for the heirs and the kids and the grandkids to gain confidence, to develop and fulfill their own potentials. It can create shared knowledge and skills, once again allowing that business owner to impart their wisdom, to share what they've learned, or empower the kids to find their own ways to develop skills and knowledge. And oftentimes creating a better way to underlie the understanding of key financial concepts, maybe using philanthropy as that safe space to talk about the family wealth. Maybe share a portion of the family wealth in that philanthropic component, in that donor advised fund, rather than exposing the kids to all of the wealth that may be going on the family's balance sheet. But in a lot of cases, that idea of developing an emotional and functional bridge between wealth, purpose, and society has had proven impact on the way that those wealth holders and the way those wealth inheritors manage to retain and continue to maintain the wealth in the family rather than squandering it. If you look at some of the most successful families that have existed in our U.S. fabric, a large number of them have philanthropy as a core component of what they do in their day-to-day family upbringing and training of how to prepare the heirs for the wealth beyond just preparing the wealth for the heirs. So we're going to take a look quickly at a couple of the giving vehicles that can come into play. You know, AEF from the donor advised fund standpoint, the idea of a private foundation, and the idea of utilizing the charitable trust. And really what we see to be most fundamental at times is the role of the anonymity in a lot of cases. The idea of, especially if there's been a mass of wealth inherited through the transition of this business, sometimes the business owners don't feel comfortable with disclosing all of that wealth. They don't want to start being on a path where they're constantly being inundated and solicited for charitable contributions by different entities. So the idea of being off the grid, off the radar, through the privacy that a donor advised fund can allow, can be extremely pivotal in that decision-making process. Sometimes the idea of being able to transfer control to the heirs in a way that the heirs can receive compensation may be a key driver in a private foundation. A lot of times the main differences between a donor advised fund and a private foundation is not how you can engage the family, but primarily whether or not the family can receive compensation in a private foundation, which they can't do in a donor advised fund, or also to the tax benefits of being able to leverage those non-cash assets to receive the greatest tax deduction possible through a fair market value deduction rather than a basis or cost deduction. In a lot of cases with the donor advised funds, these can transfer through numerous generations. Families can create a lot of the same principles and structures that they do with the private foundation. The biggest difference is that they aren't creating their own vehicle. You know, for some cases, and especially with business owners, the idea of creating a private foundation can be like running another business. And sometimes they don't really want to do that anymore. They just want to focus on the fun of giving it away. And then the idea of dovetailing them with charitable trust, either a charitable remainder trust or a charitable lead trust, can be huge. With the charitable remainder trust, as you well know, the donor can get payments from the charitable remainder trust for a lifetime or a number of years. After that lifetime or a number of years, then those assets return to the charity. And the idea of a charitable lead trust can be the inverse of that, where the charity is getting that income first, And then after that term of years, those assets go back to the family, avoiding a large amount of the taxes that they may incur had they inherited that asset outright. So in looking at leveraging some of those non-cash assets, there's some key components that we want to touch on related to how the company is structured, because that's really important for any charity when they're accepting these gifts. No charity wants to take over a company. No charity wants to start making widgets instead of doing their charitable purpose. So the idea that a charity wants to take over the business or that the business owner is somehow going to lose control of the business oftentimes is a fallacy. In most cases, there's 4 key things that the charity is looking out for. Number 1, their potential liability. Number 2, depending on how the company is structured and depending on how much of the ownership interest the charity is receiving, whether that could create an excess business holdings issue for the charity. And then the 2 biggest ones beyond that often take part in the idea of unrelated business income tax on the charity. If the charity is an S-corp or the charity is an LLC or a general partnership or a limited partnership, unless it's passive income, there could be unrelated business income tax to the charity. With an S-corp in particular, the appreciation of that stock can have huge unrelated business income tax consequences for the charity. And we'll talk in a little bit about how to mitigate that. So typically what the charity needs is they need to be able to verify that the donor has legal control of the asset, that they have the authority to consent to the transfer, that they're not under any legal obligation to sell the asset. Typically when we're seeing these gifts, we're usually seeing them happen either before or during the letter of intent stage. If the donor has already signed a purchase agreement or a legally binding obligation to buy and sell, typically that owner is not going to get the best benefits from that charitable gift. They're not going to avoid that capital gains exposure. Is the charity able to agree with the representations and warranties and covenants that are in the document? And are they going to be expected to make some kind of representations and warranties that may somehow limit or impact their nonprofit status? In a lot of cases, this doesn't have to be all of the business. 90% of the time, I think we're usually seeing that the gift of interest to the donor advised fund or to the charity is 10% or less of the overall ownership. If the company is structured where there's non-voting interest, then typically it's non-voting stock. If the company is structured in voting interest, then in other cases we may see that it is a low enough percentage of ownership where the charity really doesn't have any control over the company. The charity is primarily serving in a tag-along provision along with the terms that may be in process with the potential buyer. So in this particular instance of an example, the owner is giving maybe 10% to the charity or to the donor advised fund. As they sell their 90% to the buyer, then the charity or the donor advised fund is selling their 10% to the buyer. The donor takes a fair market value deduction of these shares. That has to be determined by an appraisal, and we'll go through that in a little bit, some of that impact. And then also too, the buyer just pays the 10% to the charity and then the residual 90% to the owner for their portion of the ownership. So in one particular instance that we had Joe, and Joe was gifting about $10 million of corporate real estate that he owned to the donor advised fund. He was in the process of building his exit plan strategy where he was rolling everything into a family LLC. And then the family LLC a few years later actually created an ESOP, and they transferred the company, which was actually a number of different grocery stores, to the employees through the shape of an ESOP. So in 2009, he gifted those properties to American Endowment Foundation. AEF then sold the properties to the family LLC. To be able to further substantiate that these properties were sold at a fair market value to the family entity and to counteract any potential discounts that the IRS may come after the family with, or any kind of self-dealing accusations that may take place, there were actually 2 separate appraisals done. Joe took the took the charitable deduction at the lower of the two appraisals. The family LLC purchased the properties at the higher of the two appraisals. So if anything, the family paid a premium rather than a discount. Therefore, there was very little likely, and to date, as far as we know, 7 years later, there hasn't been any blowback from the IRS for this transaction. In 2013, he began transferring ownership to the employees of roughly about 400 of them through the ESOP, and since 2010, up until the time of Joe's passing last year, he was making continuous grants to numerous local charities, diminishing what he had put in through the donor advised fund, with the intent that more is going to be coming through his charitable estate after his death. An example of how this comes into play when you look at the idea of maybe giving the selling the real estate first and donating the cash versus donating the real estate to the donor advised fund the way Joe did, versus maybe creating a private foundation and donating the real estate to the private foundation. You know, this is how that all can change the story, so to speak. If the donor is selling the real estate and then giving the proceeds to charity, then fundamentally they're still going to be paying tax on any of that fair market value gain in the property. So in this case, if the real estate is $10 million, they have $1 million in basis, their taxable gain is $10 million. Now, in both the donor advised fund and the private foundation, you know, that gets wiped off the table. They're donating that $10 million of real estate. There's no basis, there's no capital gain to realize within their personal wealth. But what happens in that difference between the donor advised fund and the private foundation is within the donor advised fund, that gift to charity, that gift to a 501c3 can be a fair market value deduction rather than a basis deduction. So when you look at the federal tax savings, aside from the avoidance of the capital gains, you're having a substantially greater savings on the taxes by giving to a public charity than you would had you given to a private foundation instead. Going a little further with one of our other clients, this was a client that had made the gift to us about a month into the letter of intent. He was selling to a strategic buyer. You know, to show you kind of how quickly this process can take place. You know, the letter of intent was already signed. We had our initial call on day 35 when he shared with us the existing LLC agreements and the existing corporate documents for us to review to make sure, as we said, that there weren't any warrants or representations that AEF wouldn't be able to continue as a charity. On day 59, the purchase agreements were received and reviewed by AEF. On day 64, we actually executed the assignment of 0.55% membership interest between AEF and the business. The value of those membership interests was about $1 million. On day 65, we received those shares of Horse Lover LLC. And then on day 66, we actually signed the sales agreement between us and the strategic buyer for the purchase of those shares or those membership interests that we held in Horse Lover LLC. 103 days later, after all the approvals were done within the appropriate parties, those funds were received. That $1 million was received by AEF from the strategic buyer, and those funds were released for philanthropic capital into the donor's donor advised fund. A key component of this, like we talked about, is once again the avoidance of that capital gains. If you look at the idea of the contribution, you know, he could have done this with the cash proceeds after the fact, but he wouldn't have avoided the capital gains. So his net cash ended up being greater by utilizing the strategy of gifting the stock, giving those membership interests first, rather than waiting until after the sale to give those cash proceeds. Furthermore, in this particular case, what was interesting was the appraisal on this. As I mentioned, the business owner has to do a fair market value appraisal for the charitable gift. Any charity that receives these types of interests are only acknowledging that they've received these interests. So our gift letter just said that we received, 0.55% membership interest in Horse Lover LLC. It did not attribute a value. The donor has to give an appraisal to the IRS to be able to substantiate the charitable deduction within that process. In this particular case, that appraisal was done after the sale of the company. So they were able to use the sale of the company as a critical fact in that appraisal because it was done after the fact, because the company was in a high growth mode, and because that drastically limited the lack of marketability that may exist. The appraisal in this case actually just allowed for a 3% discount for risk rather than a higher percentage of discount that may take place in that appraisal if the appraisal is done prior to the sale or prior to the gift of the asset. So in most cases, the donors have that time between the date of the gift and the date of the first tax filing to go ahead and do that appraisal and leverage the ability of using those material facts in the appraisal process. So that made a huge difference for this donor and the deduction he was able to achieve because he had a lower discount for the lack of marketability in the process. S-Corps can, as we mentioned, have that unrelated business income tax issue. We see this a little bit with LLCs and other limited liability or partnerships, but the biggest portion of where this comes into play with S-Corps in particular is all of that unrealized capital gain that the charity is going to take on in this process. By utilizing an intermediary that is structured a little bit different than your normal charity. In this case, the organization that we use is set up as a Type 1 supporting organization. They're set up in a charitable trust form rather than a charitable trust form, rather than a charitable corporate form, and that allows them to have a slightly different tax treatment with the acceptance of those shares. So in a typical scenario with a donor advised fund with a corporate-based charity, which most charities are, the charity would take on that unrelated business income tax assigned to the appreciation of those shares. We would then have to pay taxes on those shares as unrelated business taxable income, which doesn't impact the donor any differently. They're still going to do that appraisal. They're still going to get their market value deduction. But what it drastically impacts is the amount of excess capital they have within their donor advised fund. So in this particular case, we've seen a scenario where we had a case that happened at the end of the year. They reached out to us in 12/26, literally the day after Christmas, saying, hey, I'm getting ready to sell my company. Ironically enough, this was also an ESOP situation. The owner reached out to us saying, hey, we're getting ready to sell our company to an ESOP. My CPA suggested that I might want to donate some shares to you. We reached out to our counterpart in this who was able to accept those shares and distribute those to the Special Asset Trust. The Special Asset Trust ultimately sold those shares to the ESOP. In this particular case, there happens to be a note with that sale. So every year the ESOP is making payments to pay off that note to the Special Asset Trust, and then whatever is residual after that note payment and after the cost of that are applied by the Special Asset Trust get applied to the donor advised fund that the family has with AEF. So if you look at where the difference comes into play here, it really makes a difference of about $250,000 of additional charitable liquidity. As we mentioned, the donor's still going to get the fair market value deduction of the $1 million because that's being done by appraisal. That's a completely separate event. But typically, if we were to take those shares outright, we would have to pay close to 35% in unrelated business income. That would reduce the proceeds in the donor's donor advised fund to about $650,000 on that $1 million. By going through that Special Asset Trust, that Type 1 supporting organization as an intermediary, they accept those shares, they liquidate those shares, they pay a lower tax rate on the unrelated business income tax. When they donate those proceeds to charity, they're also getting an additional charitable deduction for moving those assets from the supporting org to the charity, consequently giving a larger net of $900,000 in the donor advised fund versus the $650,000 that would normally go into the donor advised fund had we done that directly as a corporate charitable entity. So think about these questions with your clients. Think about ways you can help them create this additional leverage in this process. Predominantly, one of the biggest things I've seen is actually the last one. Would they do more if they could do it anonymously? Sometimes that can play a huge role in their charitable giving. But also, how are they currently donating? How are they volunteering their time? Are they involved with boards? What's the consistency of their involvement? How are they creating leverage in these cases? What's the consistency of their giving with these causes? A lot of clients, both business and personal, would like to be able to find a way that they could create a levelized level of giving to their charities. If they have fluctuating income, if they have fluctuating revenues, the idea of being able to maybe take advantage of those higher income earning years or higher revenue earning years to put those aside so that that money can offset in their lower revenue or lower earning years could have a profound impact in how they look at leveraging their philanthropy. Whether they're donating cash versus securities versus other assets, any of those can be additional leverage points. Do they want to focus on their giving today, building a future for giving for their family, or creating a legacy plan for after they're gone? More and more often, we're seeing more and more donors, in particular entrepreneurs, really wanting to build a focus on giving while they're living, rather than structuring something for when they're 6 feet under and can't be involved and make changes to how that giving is operating. With that, I do want to thank you for your time. As we mentioned before, some of the advantages that we can help with the advisors is with facilitating some of these assets. And also, if you're in that role where you're managing or serving as a custodian of charitable capital, of financial capital, continuing to keep you engaged in that process with retaining the custody and the management of these assets. As we mentioned at the very beginning, I just want to reiterate the fact that we are fully independent. We are not financial advisors. We are not CPAs. We are not attorneys. We are not trying to compete with the professional trusted advisors in any fashion. I'm happy to take any questions with the time that we have left. I want to thank the Exit Planning Institute again for having me here, and I want to thank you for taking time to listen in on this session.
Oh, thanks, Laura. Couple of questions came in, one about the presentation and recording. Just a reminder, those will be shared for EPI members. Those will be in the Member Center. For everyone else, those will be sent out. A link will be sent out via email. And then a question about whether maybe this presentation could be done live in New York or New York City. Is that something you guys do, Laura?
Yes, definitely. We often give similar presentations to help professional advisors, either with their clients or with their collaborative partners. As you can see, my contact information is on the screen. If you want to reach out to me to discuss that in greater detail, I'm more than happy to have that conversation.
Okay, and then one more comment about qualifying for continuing education credits. So with that, for CPEs, we are not currently approved for webinars. We're in the process of having webinars approved by the NASBO board. So once that is done, we will be submitting events like this for continuing education approval in advance, and then posting that on the event page what type of continuing education it does qualify for. And it looks like right now that's all of the questions that came through the question box. So unless anyone else has any questions, I just will thank all of you for joining us today, and thanks Laura for presenting. Just a couple of reminders to all of you, if you could please fill out that brief survey once the webinar is closed. And thank you for joining us, and thank you, Laura, and have a great week.
Thank you so much, everybody. Have a great week.